talking about financial literacy, personal finance here. So thank you very much for joining. And for those that are going to be watching this recorded, well, thank you so much as well for paying attention. Today, we are going to talk about tax-free savings account versus registered retirement savings plan. And as usual, my good friend and colleague Angel Arredondo is with me today. Welcome back, Angel.
Thank you very much, brother, for the presentation and for the invitation today.
Awesome. Thank you very much. So we're going to get started. And basically here today, we are going to talk about something a lot of people ask themselves when they want to start not saving, but investing, because these two platforms or vehicles are places where we can invest our money. Am I right, Angel?
Yes, that's correct.
Perfect. So basically, we're going to talk about the differences, how the taxes affect your decision, whether you go with the TFSA or with an RRSP, some real life scenarios based on your income, your salary, which is considered yearly here in Canada and also in the United States, common mistakes that we need to avoid or pay attention to, and how to build a smarter strategy. So is a TFSA always better, or is an RSP better? So we'll see which one is better when we use both and how to learn a lot more about it. So we're going to continue here. All right, Aaron.
Yes.
You have a lot of experience with TFSAs and RSPs. So what are the real differences when it comes to each one of these accounts? Of course, in French, we call them CELI, compte épargne livre d'impôt, and REER, right?
Yeah, that's correct. Well, I could tell you that both of them are good. All depend on the what are your plan, or depend what you really want. Because why I use them both for myself and for my clients. I'm gonna tell you, uh, both of them are a vehicle that will allow you to invest for the future. Okay, as you can see there, the TFSA, the tax-free saving account. What that mean? That means that all the money that you put in that account will generate interest, right?
Right.
That means that in the future, in the next 5, 10, 15, 20 years, whatever amount you accumulate there, you can withdraw all that money without paying to the government taxes.
And why is that the case? How come the money that grows in there is not going to be taxed again? Why?
Is part of the account. Okay, as you can see, TFSA, it means tax free saving account, tax free. The name said it, right? Tax free saving account. And some people think that the money that they accumulate there won't generate high return, because most of the people are going to tell you what happened to me before is that they just put that money in the bank, and the bank tell them, okay, you can withdraw that money whenever you want. And what's going to happen if you don't have any financial education? You will accumulate money in a few more months, you will drop that money, then you are not using the program in the proper way.
Correct.
Okay, same thing happened with the RRSP. The name said it, RRSP. It's a retirement plan for the future. Okay, for the pension for the future when you retire. But what happened is that the difference is that with the RRSP, and every dollar that you put in the RRSP account, this is tax deductible, which is very good. And let's make some example. If I have a client that he's, let's say, 25 years old or 20 years old. He doesn't have any kids. He has like a decent salary, let's say 30,000 or 35,000. That person doesn't pay too much taxes, right?
Right.
What would be the best account in this scenario for that type of client?
I would go with the TFSA for sure.
That's correct. But why?
Well,
Why is go ahead.
because at this point in time, since that person is not paying too much in taxes, he's going to have a lot more benefits with the TFSA. Because let's go with the rules. 18%, which is the max you can contribute towards your RSP per year of 30,000, let's say, is $5,800, more or less, right?
Yeah,
Well, the limit of a TFSA today is 7,500 in 2026. So you have bigger room in the TFSA than the room that you have in the RSP. Plus, you are not going to get basically anything back or a lot back just by earning 30,000 and contributing towards your RRSP.
yeah, that's correct. But one other thing that we can add to your comment is that this person doesn't pay too much taxes, right? Then why to put money in your RSP when the main goal is to pay less taxes when you use
Correct.
it, okay? Because once again, both of them could work for retirement. One with that you won't pay any taxes, and the other one you will pay taxes. But why you will pay taxes? Because you get a credit. Once again, every dollar that you put in your RRSP account is tax deductible. Okay? Then, in the same case that I just talked about the person who is 20 or 25 years old, which is making 35,000 per year, I recommend, like you said, the TFSA. And eventually, when this person, let's say, has a better income, when this person has, let's say, a family, this person has a few kids, 2 or 3 kids, then we will suggest him to put money in his RRSP account. Why? Because he will get a tax credit once again. On top of that, when you put money in your RSP, you reduce legally your income. That means that you will pay less taxes. But on top of that, if you have kids, the child benefit will goes up because the government calculate the tax benefit based on your salary. If your salary is high, you won't get not too much, right?
Right,
But if
right.
you have a choice to reduce your salary with putting money in your RSP account and increasing your child benefit support from the government, why not?
It's a win-win scenario in this case.
Exactly.
So if we summarize this slide, we can say that tax-free savings account is free, whatever grows inside of this bucket, because as we can see here, these are containers. Both TFSAs and RSPs are not investment plans. They're buckets or containers where you can pick different investment strategies, and that money is going to grow. So tax-free savings account is tax-free because the money that you put in there comes from the salary that you received after you pay taxes.
That's correct.
That's why. So the government is basically saying, I'm not going to ask you to pay taxes twice, right? So, and the RSP, as Angel was saying, let's say you make $100,000, 18%, that brings your salary down to 82. So instead of paying taxes on $100,000, you end up paying taxes on $82,000. Okay, so that's going to save you on taxes. As Angel said, your child benefits are going to increase because you earn less, or at least that's what the government sees, that
Yeah.
you made less money.
Yeah.
Right? So beautiful strategies.
Yeah, very beautiful. And on top of that, let's say I'm gonna take the same example. The money that you put in your tax-free saving account when you have like a bigger situation, let's say that you are a parent, you have a few kids, you are earning more income, you and your spouse, the money that you put in your tax-free saving account, you can transfer it to your RRSP. Like that, you will benefit. You will get a better tax return when you do your income tax report, and that's the main thing, right? Uh,
Right.
I always say to people, you have to deal with a financial advisor. If you don't have a financial security advisor, I highly recommend you to get one. Why?
Well, but something happens. People think that they know everything, that they know it
Well,
all.
they think that they know everything, okay? They think that they know everything because they operate just with the information that they have. The good
Correct.
thing about that is that by having a financial security advisor, you don't have to pay him. You don't pay him.
You, you don't pay him.
You
It's
don't pay
like a
him.
free coach, a free coach.
Exactly. Free coach. And on top of that, the coach, he want you to accumulate as much money as possible because much money you invest or you accumulate better will be his commission, right? And
Yes,
the
and I got to be honest with you. A lot of people still go to banks when I have to agree. And, there's a word that people use a lot. And I'm not going to say that we don't have certain products, maybe a credit card, because through financial security advisors, you don't get that. But in reality, when it comes to investments and other things, I'm not pro banks in that sense
yeah.
because banks have shareholders. So their
Mhm.
goal is to make money for the shareholders, not for you as the client.
Yeah,
As I have said, as a financial security advisor, our interest is that you make a lot of money because if you make money, that's how we get paid, right?
that's
But
correct.
the bank is the opposite. You go to the bank, you deposit in a savings account. Again, I like to use 100,000. You deposit $100,000 in a savings account, and the return on that is going to be point 50, maybe 1.25%. When the bank grabs that money and then lends it to other people through credit cards at 22%, and they invest it in these strategies that we're telling you about, and they make 12, 10, 15%, and they give you 1% on your money.
Yeah. Listen, I'm gonna tell you what is the tricky question that they used to ask me when I was investing at the bank. Okay. Let's say if I wanted some investment like a RSP. Back then the tax-free saving account didn't exist, but the RRSP, yes. When I was investing, listen the tricky question. Do you want your money safe or you want your money risky? What do you mean? Save means that your money will be there. You will earn 1 or 2% that we will give you guarantee. That's one way. Or risky is that you can win or you can lose your money. What do you think that was my answer? Oh, I want safe.
Saved. Yeah, you want it saved.
This is the tricky question that they ask to all their new clients that want to invest. Why?
Eh,
They are not giving any financial education right there.
no.
And they have an interest on putting money safe, which
But
is
the, but they do not give you financial education because you can only give what you have. They
yeah,
don't have that. They
yeah,
are sellers.
yeah, that's correct. But when you see other thing with a financial advisor that you can invest in a stock, that you can invest in ETF, that you can invest in mutual fund, that you can invest in bonds, which especially mutual funds and stock that give you a higher return on your money.
But
And on top
usually
of
when people open TFSAs, you know what they invest in? GICs,
most of them, yeah,
guaranteed income certificates that are going to pay, let's say, 4%, 2,
not
3,
even 4% today.
2, 3%.
Yeah,
When in reality, if you go through, and we have the list here on the screen, through stocks, ETFs, mutual funds, bonds, and savings. Well, savings accounts, no, that's too low, right? But if you invest in mutual funds, some bonds, stocks, and ETFs, you can actually generate 8, 9, 10, 11%, right?
Okay, the average, I'm gonna tell you the average for the public to listen very carefully. The average in the last 30 years, let's say if you combine all the types of account that we have here in the screen, stock,
So
ETF,
if you graph a TFSA bucket or an RSP bucket and you mix it up with all these accounts,
yeah,
what is the average?
the average, you wanna know,
Yeah, I want to know, of course.
is 8 to 12%.
8 to 12%. Wow.
With all kind of situation, with all kind of difficulty in the world, uh, 8 to 10%, 8 to 12% in the last 30 years.
And you know that at 8%, let's say that's the average, at 8%, your money doubles automatically in 9 years. Whatever
Yeah,
amount you have today, if the
double.
market keeps performing at 8% average, your money is going to double without you having to touch it again.
Yeah. And for this audience today, what we're gonna do is that we can offer what we always offer a financial need analysis. They don't have to pay for. It's completely free for them today. You just have to put the FNA, financial need analysis, in the comment. Put FNA, and then we will identify which of those two accounts will be better for you depending on your situation. Once again, we always try to find some strategy to help you out to increase your investment. And most of the people, sometimes what we're gonna do, we will recoup money from the money that they are paying already. Okay, let's say a simple example that we have here: someone who earned $100,000 per year, that's the income, and this person put $10,000 in his RRSP account. Then all the money that he will pay from 90,000 to 100,000, it will get it back as a tax return.
So
Once it,
basically, if I put 10,000, I'm only going to pay taxes on 90,000.
90, yeah,
But because my tax bracket at 100,000, well, 90,000 is around 30%, let's say, I'll probably get $2,700 back.
there you will get around 3,000, 3,000 to $3,500, which is very good,
Very good.
very good.
Which you can take and invest in your TFSA.
Yeah, what I say is that your 10,000 become 13, 13,000 right away,
Right,
right away.
right, right.
Because the thing is that most of the people, they don't know that. This is a simple thing to do, but you won't do it if you don't know. You see, I have a client that they earn 100,000, 200,000 per year, and I sit down with them twice a year to find some strategy on how to save on taxes and how to increase the child benefit. And when I sit down with them, they always are impressed. Wow, I didn't see it that way. Oh, okay, I didn't see it that way. And you know what? Most of them, they maximize their RRSP account because there is a maximum. Okay, they maximize their RRSP account.
So
Now,
there are two maximums, right? The 18% or whatever your notice
yeah,
of
this year is
assessment.
33,800, something like that. The
That's the
maximum.
max.
Yeah, or 18% of the previous year that you work. And if
Or
you did,
whatever your
you did not
notice of
contribute,
assessment,
it's accumulated.
but whatever your notice of assessment says
Yeah,
is
the
also
federal
valid.
one, the federal one. Yeah,
Yeah, the federal, the blue paper that you
yeah,
receive after you file your taxes.
yeah, exactly.
Okay.
Then when you have someone like that, let's say that this person had two kids, his wife or her husband work as well. They have the same salary. If they don't have any strategy, that's mean that they will pay a lot in taxes, right?
Yeah, that's true. That's true.
And then when we sit down with them, like I said, they are always impressed. Why? Because uh, we always find a way using some strategy that will help them to get a better tax return, and they don't have to pay for that. But you know
No,
what? Like you said, or like you mentioned before, people think that doing what they are doing with what they know, they we are getting the max. It's not. It's like if you are going to the gym, it's not the same thing if you train alone than you have a trainer with you. Imagine if you would have a trainer that doesn't cost anything when you are going to the gym. Will you use it?
everybody would use it,
Of course, why not?
but when it comes to money, they don't.
But some of them, right? But most
Well,
of them, they don't.
most of them, they don't.
Because this is a topic that most of the people, they don't like to talk about.
I know, it's
You
crazy.
see, when we go to school, we learn all kind of things that we will never use in our life. Like, how do you say that in English? P 3.14, something like that. Pi.
Oh, pi, yeah, pi.
Pi 3.
3.14, 16,
Oh,
etc., etc.
man.
Have you ever used it?
Who used that today?
No, have you ever used it?
Never in my life. I used it only when I went to school.
Listen, I was talking to someone about it yesterday. I said, look, the first 6 years of school, I think they're instrumental because you need to know, or you need to learn how
Read,
to
how to
read,
count.
how to count. But I think, look, in life, we are perfectly fine with adding numbers, subtracting numbers, divisions, and multiplications. That's it. Do you apply any calculus in your life? Geometry,
Yeah.
trigonometry?
Unless that you will make a career in some special field like an engineer or something like that. That's correct because they need it,
Right,
right?
right.
But for most of the people, a doctor, tell me a doctor, he has nothing to do with that,
Nothing. No.
right? The system will teach us how to earn an income, but they will never teach us how to use that income.
Which is crazy. But at the same time, and I repeat myself here, you can only give or teach
What you know?
whatever you have, what you know. And even
Yeah.
the school teachers are going through financial struggles
Yeah, that's
because,
correct.
as you said, they were never taught how to deal with money, how to invest money, how to put money to work for them, right?
Yeah,
So how can they teach that to the kids? They can't.
exactly. They cannot teach what they don't know, like you said.
Correct. And
Listen
here
here,
yeah, go ahead.
listen here, what we have here that you just put there. As
Yeah, it's
the
really a
higher
rule of
your
thumb.
income, the more valuable RSP contribution will come, which is very true.
Right.
Just keep, guys, the people that are in the audience, keep that in mind.
Yeah,
Low,
just take a picture of this, or the recording is going to be available. But this is kind of a rule of thumb. Whatever it says here, higher income, RSPs, low income, TFSA,
okay.
high income earners, RSP.
And
And
then,
if it's middle income, then both are a good match.
yeah, exactly. And if you have a higher income and you maximize your RRSP contribution, I highly recommend it to maximize as well your tax-free saving account.
Correct.
Because both vehicles are very good. Because what they are saying is save money, invest money. Money will work for you. Today, most of the people are working for money.
Right.
This is a
And
way on how this is a way that you will discipline yourself on how make money work for you.
I gave this example last time we were here live on LinkedIn. And I said, if my daughter turns 18 today, that's when you are allowed to start contributing towards your TFSA account. And for the next 47 years, until 65, every year on her birthday, she adds $7,500, which is the limit today, but that changes every year. So it's going to be more in the future at 8%, which is kind of the average there. For the next 47 years, she's going to end up with about $7 million. Is that good?
This is not good. This is amazing.
Amazing.
What happens is you're talking only about 7,500, which
Right.
is which is not a fortune investing every year, right?
Right.
And if she doesn't do that, what's gonna happen? She's gonna spend the 7,500.
I imagine if she adds, let's say, every year until 47, well, until retirement 65 for 47 years, the 7,500 again, which is going to grow in the future because every year the government calculates based on inflation and other things and brings that up a little bit. So she does that on the TFSA account, that's 7 millions. Imagine if she does 18% on the RRSP at 8% for 47 years. It's going to be what? 15, 20, 25 million dollars?
Amazing, man. Amazing.
Crazy, you know?
Yeah. And once again, by putting that amount of money, she's can live comfortable because you have to focus on. Because if you don't have any focus on your future, you won't get anything. Let's see here. The power.
We have a question. We have a question now.
Yeah, go ahead.
So Fanta, thank you for being with us today. So Fanta is saying that is an interesting take. Could it be that most people do not genuinely know the services of financial advisors is free?
No. Okay, that's a very good question. What happened is that, like you mentioned before, when you don't know, you don't know,
True.
and you won't ask what you don't know, right? And if I have a goal, let's say I want to buy a house or I want to retire at 55 instead of 65, I need to have a plan, and I have to be
Yes.
disciplined with that plan. If that's if that is important for me.
Yeah.
What I have to do, I just have to hire a I have to hire a financial security advisor. When you're gonna buy your house, you're gonna do it on your own, or you're gonna hire a real estate agent.
A real estate agent for sure.
Right. You don't have to pay the real estate agent when you buy. Same thing happen when you have a financial security advisor. You don't have to pay him. He get paid when he do business with you, but the company, because he brought a new client to those company will pay him a commission, right?
Right.
You will benefit of the some concept that will allow you to accumulate money. You will benefit using some strategy that will allow you to get a better tax return. You will benefit by using that strategy to increase your child benefit. You will have a plan and you will have a coaching. The coaching you don't have to pay for.
And it's always available. And this is, again, one of the things why I don't like banks. When you need an answer, you have to call an 800 number, talk to Jean Bilodeau or somebody else. You don't even know. That person's not going to treat you as a client, but just as a number. It's just another call. Right?
Yeah.
But when you have a financial security advisor, you can call him or her 24 hours a day.
Yeah.
Of course, we're not going to
It
call.
doesn't mean that he will answer right away, but he will answer faster than a bank.
But it's a personalized advisor that you have on your side.
That's
right?
a very good comment that you just said. I do remember myself when I used to do business with banks. I used to work at downtown Montreal, and I used to go to a branch downtown, which it was close to my work. At this time, at my lunch time, I was going there for 15, 20, 30 minutes. Do you think that we can plan our future in 15, 20 to 30 minutes? No. The thing is that after 3, 4, 6 months, I have someone else because the other person wasn't there. And then I have to start again, explain everything, what I wanted. That's not a good idea to do that.
No.
Like you mentioned before, by having a financial security advisor, It will be a plan for you and your family. It will be personalized. It will be uh, exactly to you with your goal. And this person, like you mentioned, you can call him anytime.
And that's why we talk about the financial analysis,
Yeah.
right?
When you have a coach, what's gonna happen is that you're hiring a coach, which you don't have to pay. The coach will design a plan for you based on your goal or what you want to accomplish, right? And then we
Right.
will work together. What's
Yes.
gonna happen is that we will just maximize what you know already, because we will see the picture in from other way that maybe you don't see. We work in the field. We see what happening every day. Maybe, or if you have some information, and if you don't update those information, you will think or you will believe that those things still like that. But we have to update the information every day by having a security, by having a financial security advisor. He will help you out with all this till you accomplish your goal, and you don't have to pay for. But everything starts when you make a financial need analysis. Okay,
Correct.
and
So
we
you can write that financial need analysis FNA in the comments,
FNA. Put
and
FNA
I'll
in
reach
the
out to you
comments,
guys.
and then we will do it for you. You don't have to pay, and you are not obligated to do business with us. We just
So
gonna
this
give you
this
the
this
information.
slide has been on the screen. You guys can read. These are the benefits of TFSAs. A lot of benefits there, but believe me when I say this, when you open a TFSA, ask the institution you open it with if there are any penalties. Actually, some institutions do have penalties if you take the money earlier, but in
Yeah.
reality, that should not be the case. So you need to ask. But great benefits here. You can withdraw at any time, no taxes when you withdraw the money, even if it's $1 million because of your earnings in the future. Great for emergencies, for short-term goals and future opportunities, right? So you can use it as an emergency fund. You know that in reality, you should have from 3 to 6 months of your monthly expenses in case something happens, in case you lose your job. You know that chômage or unemployment, the
Unemployment.
max is, I believe, around $2,400 to $1,600. It's going to be hard for people making a lot more than that, or spending more than that every month to live on that. So it's always good to have an emergency fund. Car purchase, which we recommend to buy cash, not through lease or unless you have a business, or through loans, right? And some other topics. Now, this is a slide I want to focus on a little bit here. TFSA, and Angel mentioned this. Angel has been here for over 20 years in Canada, but TFSAs did not start until 2009. So whoever was here in Canada or lived here in Canada before 2009 did not have this opportunity. Now, when it was implemented in 2009, whoever was 18 years old at the time was able to start contributing. At that time, it was $5,000 per year. Okay. And the earlier you contribute, the better, because that money has 12 months to grow. Right. Then, as you can see here on the screen, 5,000, 5,500. So 2026, it was pumped up to $7,500. But for those like me who came to Canada after 2009, I don't have the contributions since 2009. My contribution starts the year I get to Canada. Okay. So in my case, I got here in 2015, which for some reason it was pumped up to $10,000 that specific year. Thank you.
I don't
And
remember
then
why.
you have to calculate, in my case, again, since 2015, you add all these numbers, and that's the amount that you can contribute towards your TFSA if you have never contributed anything into it. Now, if you have been here since 2009 and you have never put a single penny in your TFSA, your contribution room today is $109,500. That's a
Tax
lot of
free,
money.
tax free.
Tax free. You put the money there, and as I said, you put all that money. If you have the money, you can just go to the bank today and put 109,500 if you have been here since 2009, and at 8% in 2 periods, you're going to end up with $500,000, $400,000. Okay, and
Yeah.
on the right side here, you can see the addition. So the total, how it gets to $109,500. Okay, so I just wanted to show that on the screen so that you guys understand and know exactly how much you have available in your TFSA. Okay, these are some other plans here that, as you mentioned before, could benefit when you put money in your TFSA or RRSP. Do you want to talk a little bit about FHSA and RESPs?
Yeah, the FHSA, like you said, is a first home saving account. What that mean? It's a mix. It's a mix with tax-free saving account on RRSP. Oh, what do you mean a mix? Yeah, let's say is the son of tax-free saving account on RSP. Okay, that means that any money that you put there is tax deductible, but when you withdraw that money, you don't have to pay the taxes back.
Which is the case with the RRSP. Yes.
Exactly. But I always use that when someone has maximized, we can put both. This is $8,000 per year per person. Okay, the maximum that you can put today. Okay, let's say if you put that money there, the maximum, and you still have room to put more money in your RRSP, I will highly recommend you to maximize both.
So in this case, now you can contribute to TFSAs,
Both of them.
RSPs,
Both
and
of them at the same time.
FHSAs. So 3.
Yeah, the thing is that you will always have to find some strategy for the client to maximize what the government will give him.
Correct.
All the time. You cannot do it on your own. I see rare some people that they can do it alone. Some, but not most of the people. You have to know that when you do business with an expert, it's proven already. Within 3 years, you accumulate double than if you were to do it alone.
Wow. Wow.
Within 3 years, which is a short period of time.
It is.
Right? Then there's
also have the RESP or
RESP. The RESP is for the for education for the kids. Normally, government can give to the family 20, 30 to 40% of the amount that they put in that account. All depend on the salary. But once again, when you put some strategy that you reduce your income, that means that the government will give you the maximum for the RESP account for your kids.
It's like a balancing act.
Exactly.
You have to play with it.
But if you don't know, you won't do it.
You don't know. If you don't know, you don't know, right?
That's what it is.
Yeah.
Then once again, how many people do we have there in the chat that put FNA that they can get a free financial need analysis? Guys, we have 5 more minutes to do that. If you don't do it now or today, then we don't know if we will offer that next our next presentation. Is now, which is happening.
And then it's important to mention here at the bottom too that sometimes when you have a job, which is the case we see in the society and most people, right? Your employer is going to match a certain amount of whatever you contribute towards your retirement plan, RSP. Take that. Always
Yeah.
take it. Even if you don't open another one, which we still recommend that you do outside, right? Take it. Why? Because let's say your employer matches 4% of whatever you put. That means that in reality, you're investing 8% of your salary every month. Every month, right? So, and that's not only that. If you invest 4 and they give you 4, you're making 100% on your investment. You will never get that from anywhere else. 100%. So you have, it's not like an option. You have, you must, you out to, right?
Yeah.
Take that match because it's really the best thing that you can do towards your retirement plan. And we cannot leave our retirement planning to the government. No, you have a lot of clients right now, but what is the max someone expects to receive in retirement without planning for it? 1,600 maybe?
No. 13 to 1400.
Who can live on that?
No. Some people 1800. Some people, not all of them. Those are the people that work here for over 40 years and they were earning a good income.
Oh, very, very good question here by Fanta again.
Yeah.
It's kind of a common, but she says, is it fair to say that consistently contributing over time tends to generate better returns than delaying investment and making a large lump sum contribution years later, provided there's sufficient contribution room? She's right.
Point one, the first one, if you constantly contribute, you will get a lot of benefit. Why? Because the market will go up and down, up and down, up and down. If you keep on putting the same amount of money constantly or higher, or you can reduce it, that means that when the market is down, you will benefit. And then,
but if you only put a lump sum X year
maybe
and the market is
that
down
person
that year,
will buy a stock when the market is high. Then if the market is high, that means that you are getting less.
right?
Okay. Then if you keep on constantly putting money in your account, that means that you will benefit all the ups and downs, all the ups and downs. That was a very good question. I highly recommend it to do it constantly. Doesn't matter the amount that you're putting, but it's better constantly. That means what? That if the person is ready to invest $6,000 per year, it's better to put 500 every month.
Right. And here we're giving some strategies here before investing. Make sure also that you pay off your high interest debt, like credit cards. Car loans are high in general, right? Build your emergency fund, maybe not 6 months, but at least 3 months of your monthly expenses. Take your employer RRSP, as I was saying, very important. You have to, you must. And consider, if you're planning to buy a house, investing in a FHSA. And actually, I believe for next live, we'll probably talk about FHSA versus RAP or RAP, right? Which comes from the RRSP, but that's a different topic. We're not going to delve into it today. It's going to be for another session. And here, so we have very simple examples very quickly here. Income of 40,000, 45,000 today. In the future, you're going to make more TFSA, right? 85, and in the future, you're going to make less. Let's say you are going to retire at some point, but today you're making 85. Well, RSP, because in the future, you pay less taxes, right? And here, two more examples, 150,000. Future income lower because of retirement again. RRSP, aggressively put a lot of money against it, right? And if you need the money within 5 years, well, TFSAs, we don't advise you to take money out of your RRSP because that's going to be added to your salary. Just the same way as it was deducted from your salary, if you take it while you're working, it's going to be added to your salary. So you have to end up paying more taxes. Okay. So it really depends on your situation. We have been saying it. I think having a financial security advisor, it's a great idea. It is free. People pay coaches at the gym. People pay coaches. How do they call them now? Life coach. People
Yeah,
have life coaches now. People have doctors. People have coaches for a lot of things. But when it comes to money, they believe that they know everything, which is, I think, wrong. Okay.
yeah,
All right. So as we've been saying, if you write FNA in the chat, then we are going to provide to you a free financial need analysis to kind of better understand not only us, but yourself, your current situation.
yeah.
Anything else, Angel?
I think that I highly recommend it all the time to people. Don't expect to be ready to start investing or to start taking control of your own personal finance. You don't have to be ready to start, but you have to start to be ready one day.
Powerful.
Okay. And once again, people that write FNI in the chat, we will do a follow up with them. The main purpose for that is just to see what are your benefits that maybe you don't know. We will make a plan for you, and we'll do a follow up, a coaching, and you don't have to pay for. Okay?
Amazing.
Yeah. Well, that's it for today. I hope that everything that we said today could help you understand better what we call investing or personal finance. And I think that this is a very important topic, especially for us, the immigrant that come here to this country, which has a lot of abundance, a lot of worth. But I think that most of us would just work to sustain the system and pay invoice,
And to be tired.
to be tired at the end of the day. Um, I could tell you that you can enjoy your life today and invest for the future to have a better life.
Correct. And definitely, for sure, with a financial security advisor, you can do both, right?
Yeah.
You can do both because life is a balance. And just to close it out, I remember when I met Angel, I saw how kind of free he was. I said, I want to do what you do.
Yeah.
But again, that's something else.
You see, talking about freedom, like you just mentioned, hey, we are here just for a short period of time in this world. If you just focus on working, 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 and don't enjoy your life, I think that it's not worth it. You have to have the control of your own life. Travel whenever you want to travel, do whatever you want to do. And you don't have to be 65 to do that. You can start now with a plan, with a strategy that will help you out how to maximize what you have already. That's it.
That's it. Thank you,
Yeah,
Angel. Thank you,
my pleasure.
everyone, for being here with us. And we'll see you next time. Enjoy the rest of your Friday and your weekend.
Keep it
Ciao.
up. Bye.